Okay, let's go ahead and get started here. Good afternoon, everyone. Thank you for joining us today. We hope that you are all staying safe, healthy, and at home with your families. We appreciate Elliot taking the time to be with us here today to talk to all of us about his economic forecasts during this unprecedented time. Dr. Eisenberg is the former senior economist for the National Association of Home Builders and a widely respected speaker on construction in the U.S. housing market. He earned a BA in economics with first-class honors from McGill University in Montreal, as well as a master's and PhD in public administration from Syracuse University. We know that everyone is eager to hear about how COVID-19 will affect the housing market and the construction market. Elliot can shed some light on what he predicts will happen in the coming months and provide valuable information for you and for your business. Before we get started, I want to emphasize the why behind why we were doing this. As your most valued relationship, we feel it is our duty to provide resources to help you stay educated during this fast-changing market. This is an unprecedented time and a territory that no one has experienced before. And we want to stress the importance of understanding the lending market and how that impacts each of your individual businesses. It will help you better understand the decisions that we are making as an organization today to protect our future in the lending business, as well as the businesses that each of you work hard every day at. We'll open it up to questions at the end, so please save your questions for that time. And Elliot, I'll turn it over to you and let you take it from here.
Thanks so much, Kurt. And where do I begin? I mean, every day seems these COVID events, they come in rapid fire succession. COVID years are like dog years. I think the last week was the longest year of my life, so to speak, right? So let's try and put this into a little bit of perspective. And we can begin by looking at the GDP equation. That's always my favorite way to start. And what you see here is four terms: C, household consumption; I, corporate investment; G, government spending; and net exports. As we were going through January and February of this year, when things were terrific, C was driving the boat. There was no I. Corporations were not investing in plant and equipment. Exports were not really going anywhere. And government spending was actually slowing down because the impact of tax cuts in 18 were largely spent. So all we had was C. And the problem is, when you lock down most of the country, C goes away. That's the problem. Of those four things in the equation, as I go back one slide, as I go forward one slide now, I'm sorry, they're all no good. C's shrinking rapidly. I's wasn't going anywhere. X isn't going anywhere. And now suddenly G is now starting to go crazy. The government is throwing everything at us right now. There's no ands, ifs, or buts about it. They're throwing everything at us. The market's going up today because the federal government's doing stuff, which we'll talk about in some detail. And this makes me relatively happy. I mean, it's not perfect, don't get me wrong, but it's improving. The worst situation, the worst outcomes, the worst likelihoods are a thing of the past. What we now really have to concentrate on and wonder about is, do we get back to work? Does COVID go away? Do we have an injection? Do we have a treatment? Will there be a boomerang effect in November or December? And these are answers we just don't have right now, right? But if you look at this graph here, what I want to show in this graph is not the particular forecast. Mind you, the rate of deterioration in the forecast. How just about a month ago or 5 weeks ago, expectations were a 2% GDP growth this year. And then about a month later, by late March, the expectation was a negative 3% GDP, a change of 5 percentage points in a month, 1 percentage point a week. I mean, this is a serious deterioration in economic conditions that absolutely nobody foresaw. I mean, I'm sure someone did somewhere, but not many of us did, that's for sure, right? So to give you some inkling as to what the range of forecasts of future GDP growth for Q2, which we've just been in now for a week, vary, is, at one point you got -10 roughly at the top of the scale and -40 at the bottom. I mean, this tells you how unprecedented it is, how little we really know about what's going to happen, how much we have to make assumptions about things we just don't know. If I had to make my guess based on these forecasts here and my modeling, I would say negative 25 to 30% of GDP. I think April is going to be just an absolutely god-awful month, and May is not going to be much better. We'll get out of our house at some point in May, but it probably won't be the 1st of May is my guess. I think it gets pushed back to the 5th or the 10th or something, but it isn't going to be quite as fast as we'd like. Oh, this slide doesn't come up, but oopsie daisy. How did I do that? Oh boy. Wow. Can someone help me here? Not sure what to do there. Oh, there we go. Okay. So the next slide looks at a potential outline of GDP decline in growth. And what you see in this forecast is a roughly 30% decline in GDP in Q2, a reasonably pleasant 15% increase in Q3, and then less growth each subsequent quarter. So it's down harsh, up strong, and then slow deterioration, but pleasant growth. That's plausible. We simply don't know enough to know. We really don't. The question I can tell you for sure I can answer is we're not going to get a V-shaped recovery. That's not happening. Either it's going to be a U if we're lucky, right? So there's more hanging around at the bottom. People now are talking about the bathtub recovery, so it's down, flat, and up. I don't think we see that either. I think it really is a check mark recovery, where the down is very steep because you can close a business very rapidly, but the recovery is much slower. It's strong and robust, but it's not like that. It's more like this. And I'll take that. That's fine. So we don't know how steep the decline will be, but we know Q2 will be the worst quarter in U.S. economic history, bar none. Worse than the Depression. It's unbelievable how bad it will be. But government spending and fiscal policy and monetary stimulus are going to come to the rescue and ameliorate the worst of the problems so we can focus on hopefully staying employed, keeping our businesses open, and getting ready for the charge when things begin to improve. That's really what's going on here. In terms of consumer confidence, it's declining pretty rapidly. That's really the important thing to note here. If you look at data that's high frequency data, every day or two type of data, you see things really falling off a cliff here. And I'll show you some more slides that reconfirm this in other sectors of the economy. But consumer sentiment is rapidly deteriorating. It's not going to go on forever. And it wouldn't surprise me if in a week or two it kind of levels out, because you can't sustain these huge declines forever. There's no consumer confidence left to have at that point. It's got to level out. But there's been a big hit. Now, for some numbers that we're somewhat familiar with, did it again. I'm sorry, guys. This is University of Michigan data. And this data came out, interestingly enough, new data on this series came out today, and the number fell precipitously. The number fell to about 70 from 90 or so. So we've had a huge decline in consumer confidence here, right? I mean, things have really deteriorated. So don't expect the consumer to ride to the rescue. They're not going to buy a car. They're not going to buy a house. They're not going to do a lot of fancy shopping. It's just simply not going to happen, right? This is consumer confidence in Germany, right? It's also really, really weak, and it's deteriorating because the whole world is deteriorating too. Q2 is really going to be a really bad quarter. There's no ands or ifs or buts about it. Don't look at Q2 and extrapolate to the future. That's also really important. I want you to sort of compartmentalize what goes on in April and maybe the first part of May till we get out of our houses. And then things begin to improve. It's like I want to wake up and get to end of April, the middle of May right now. Why do I have to go through this deterioration? There's nothing we can do about it, but we will get out of this because the government is very actively involved in trying to help us, right? This is data I got yesterday or today, actually this morning, on hotel occupancy rates. And you can see occupancy is down just about 70%. The rate that you can charge per room is down 40%. And the revenue received per room is down 80% because the rooms are all vacant. So we're not going anywhere. We're not going traveling by plane anywhere. This is unprecedented declines, and they will now be here throughout the month of April. Remember, the month of March, the first half of March was good. It was the second half of March that went down the drain because more and more of us began to be locked into our houses. But the first half was good. April's all going to be bad. That's what makes April different than March. Right? We're a little more ready, but there's no action going on in our economy. All the outdoor action's not happening. So it's like it's as if our economy is in a coma. It's as if economic time has stopped, but financial time continues to go on. Every day you wake up, you owe $10,000 on your mortgage, or $3,000 on your mortgage, or your rent, or whatever it is, right? So you're seeing just a stunning decline in economic functioning and activity because of this. Here's a slide on movie ticket sales, and it's now already 10 days old. I haven't gotten more recent data on it. It was already down by 2/3 or 3/4 of its original level. This is unbelievable, right? This is restaurant traffic. There isn't any restaurant traffic. This is really unprecedented. So we've looked at all these small expenditures: movie tickets, restaurants, hotels, airfare. Let's look at some bigger ticket items now to get some feeling of what's going on. And here you've got, this is automobile sales for the first half of March. This is the good half of March, right? And you can see pretty much across the board in the places where it was most hit, places like Seattle, right, where it was very badly hit in the first part of the month, or the worst place in the country at that point. Things were down appreciably. In Detroit, they were up, but of course they're down now because Detroit's more of a hot spot. This was the first half of March. So think about this. You're down 15% in the first half of March, but the bad half of March is yet to come. So what do you see? Look on the very far right, the vertical decline. You've got a 33-35% decline in automobile sales in the entire month of March, mostly focused on the latter half. So April is going to be much worse than March because March had the first half that was good and the second half that was bad. April is just all bad. So auto sales will probably fall by 2/3 in April. And by the end of April, will the stock market recover a little bit? Who knows? A lot more of us will be unemployed. They'll start to improve come June or July when things begin to get better. But will people buy a car at that point? I'm not so sure about that. I mean, I'll be honest, thought, I just moved to Florida. I thought, it'll be nice to buy a car. But I thought, I'm going to wait and see how things go before I buy a new car at this point. So maybe I'll look, but I don't think I'm actually going to purchase. So if people are like me, and it seems to be they are, or I'm more like them. But there is good news out there. There is good news out there. If you look at marijuana sales on this slide, I don't have the slides, but gun sales are up and booze is up. So I guess being in close proximity to your loving family causes you to guns, booze, and drugs. I don't know, at least in Washington state and much of the West, drugs are legal. Out in Florida here, they're still illegal, so we don't really talk about that much. So there are a little bit of mitigating circumstances, but not much. If you put it together, household consumption, the first term in GDP, the term that was driving our economy going into Corona, that was driving us in January and February, is now gone. If you look in this graph, what you see here is decline in spending of about 2.5%, right? In the last recession. This time it's going to be measurably worse. It'll be down 15 or 20% or 25%. Huge declines in consumer spending. We're not going anywhere. We don't have income. We've gotten laid off. We haven't got our unemployment checks yet, and so on, right? There's a lot going on there, right? If you look at the next slide, this is small business sentiment. It's also began to decline dramatically, as you see in this slide, but the latest data is now where the arrow is. So there's been a huge decline in small business sentiment. Not surprising. Small business is taking it the hardest. Bigger companies are going to get money from the federal government, right? Public companies and so on. High-rated companies can borrow from the Fed, but the largest 100 employees, 200 employees, 50 employees, 500 employees. This is the meat and potatoes of small business. And they're restaurants, dry cleaners, they're all very nervous. Consumer sentiment is gone. We're not expecting any investments in plant and equipment now. Firms are not going to build and buy anything. All they're going to do is hold on to their place, talk to their landlords, try and pay their workers, try and make a deal with their landlords or whatever it is, their tenants. If they're an owner, you get the idea, but they're not going to invest in new property at this point. It's simply not going to happen with this level of uncertainty that's high. This isn't risk. This is uncertainty. You can model risk, but uncertainty is something else completely. The confidence intervals, 95% intervals, really start widening a lot. So it's almost impossible to make good decisions when there's so much uncertainty. But cash is king here, right? So we're not going to do a lot of stuff. Next slide looks at another measure of business conditions about 10 days ago. They're much weaker than they have been generally over the last while. So by all measures and all indicators, small business is not happy. This is oil production, if you will. This is how many rigs are being used to drill holes in the ground. And you can see that it went down for a long time in the center of the graph to the right-hand edge of the graph. It went down. And it leveled off a little bit late last year and early this year. For 3 or 4 months, there was some nice leveling off at just below 700. And then all hell broke loose because the Russians and the Saudis are having a fight. Neither of us can afford this fight, but they're both having a fight, hoping the other side blinks. And in the meantime, the price of oil is completely collapsed. So we're having, this is amazing. And because it's collapsed, prices have fallen. So the Russians and the Saudis both want to jack up prices and have the other one cut production. Neither is willing to cut production. So they're going to start producing more oil. Now, it sounds like today they may make a deal. I don't know. They have to make a deal. Economically, they're forced to. But what we've got now, immediately right now, is a once in a generation increase in supply. Every 10 or 20 or 30 years, OPEC goes bonkers and does stupid things and production just skyrockets. But we have a once in a lifetime destruction of demand. So we're reducing demand by about 20 million barrels a day. There are 100 million barrels in the globe daily used, falling by 20% with a 4 or 5% rise in supply. So we're oversupplied now by 25 million barrels. We're running out of space to put the barrels. This is unbelievable. Some oil, like Western Canadian Select, which is low quality and comes from far away and has to be shipped to the Gulf of Mexico, is now costing yesterday it was $7 or $8 a barrel. A whole barrel of oil for $8. Unbelievable, right? This is what you see here. The destruction of global demand is absolutely unprecedented. Normally, if you go into a global recession, oil demand falls by 1 million barrels, 2 million barrels, and it happens very rarely. This is 20 million barrels on top of a 5 million barrel increase in supply. Okay, oil's cheap, big deal. No one can go anywhere in their cars. So there's no demand. Planes aren't going, ships aren't going all that much. Oil prices are well down. So consumers aren't buying things, corporations aren't investing in things, oil prices have collapsed, oil investment. And if we go back a couple of slides, this is informative. If we go back to the 2015-16 period on this graph, when oil prices went down precipitously at that time, it almost drove us into recession. It didn't, but it came close. So now the decline in oil production and prices by themselves might well have tipped us into recession. I don't know. But with the coronavirus, it's just adding insult to injury. Oil prices are now $20, $22 a barrel. They're remarkably low. In terms of corporate profits in 2020, they're clearly not going to go anywhere. We'll see what earnings season is going to start soon, right? The first quarter earnings season will begin. And hopefully we'll get the earnings numbers for Q1 aren't going to be awful because Jan and Feb were really good. And the first half of March wasn't so bad. But the second half is terrible. So we'll see how it goes. But second quarter, do we get even any guidance? Remains to be seen. I'm interested to see, but we're just not sure. The next slide, so corporate profits are going to be horrible in Q2 and horrible for the whole year, I really think, right? It's going to be hard to recover from these unprecedentedly bad quarter we're going. I mean, really unprecedentedly bad. We'll talk about this quarter the rest of our economic lives. Oops, went too far on that slide. If we go back one slide here and look at corporate debt, the issue I want to draw your attention to here is the area in gray, just below the yellow. This is BBB corporate debt, so it's just investment grade. If this is investment grade and AAA is up here, AA, A, then BBB is here. And then you get below BBB to BB plus, you fall below investment grade. Lots of places can't buy your debt. At that point, you can't fund your activities. And you're going to turn the healthcare crisis into a financial crisis, into an economic crisis. And the central bank is desperately trying to prevent us getting into a financial crisis which becomes an economic crisis, worse than it is because of COVID, which we can't really control. And they're going to start to lend to anybody with collateral, literally. They just announced today a $2 trillion lending package to state and local governments and businesses and all kinds of places, so that these companies that need money can get it one way or another and don't collapse when they have to refinance their debt that's out there, right? And their interest rates don't start to skyrocket because of a lack of demand. But you can see this triple B debt, it's purple on the far right of the graph, top of the far right bar, is now being downgraded quite rapidly. So again, you've got this financial healthcare crisis leading to a financial crisis, which you see, and the Fed wants to stop the healthcare crisis from becoming a financial crisis and wants to stop the financial crisis from becoming an economic crisis and put buffers between these areas to the extent they can. This has made me very happy. I've never seen the government act so quickly and so forcefully and in such large amounts. It is unprecedented, and it should give us confidence that the worst isn't going to happen. This is not going to become the Great Depression. We're not going to be sitting here for 5 years going nowhere. We can again argue V-shape, U-shape, bathtub shape. Yeah, fine. But there's a top, there's a beginning, a middle, and an end, and it's going to be, right? This is a very different world. Manufacturing, unfortunately, is also going into recession. They were in recession for most of 19. And then at the end of 19, early 20, they began to come out of recession, maybe. And now they're back in it. And Europe's the same way, right? So nothing good coming there. So if you put all this together, the lack of investment, the lack of desire for investment because of uncertainty, the oil prices being low, corporate profits being bad, manufacturing not doing well, consumers not spending, it isn't surprising that, oops, I missed a slide here. It isn't surprising that corporate investment in equipment, factory utilization rates on this slide, I'm sorry, is pleasantly declining. This is before COVID came. So now with COVID, it's going to be even less. So corporate investment in plant and equipment, the second term in GDP, is going absolutely nowhere. Absolutely nowhere. Firms aren't going to be investing in plant and equipment. This date is again before COVID came on the scene. So we're not going to have anything going on there. But as I've stressed before 1,000 times already, if I run it once, government spending is coming to the rescue. We've had a package 1 of 8 billion, package 2 of 50 billion, package 3 of 2.2 or 2.3 trillion. We're now talking about package 4 of 3 or 4 or 500 billion dollars for small businesses primarily. And lurking in the middle of this $2.2 trillion package, somewhere in the middle, I think in orange, darker orange, there's $454 billion going to the Fed. And that's going to essentially indemnify the Fed against losses they're going to incur when they lend that $450 billion 10 times over to roughly 4.5 trillion, of which 2.5 trillion was announced today and caused the stock market to jump up. So we've got the Congress and the president and the administration pushing money out there left, right, and center. And we have the Fed that's gone all in. They are all chips in. They're not taking any hostages. They're not shooting. They're just taking prisoners and whatever. I mean, they're just going hog wild. They've increased their balance sheet by $1 trillion just about in a couple of weeks. This is really unprecedented. What Congress is doing is big, and what the Fed's doing is huge. And the Congress will do more in giving money, and the Fed will do more if they have to. They said today they will do pretty much whatever it takes to keep liquidity in the system, and people who have collateral to lend, they will lend against that collateral. Central bank can't give away money. That's not what they do. They lend, right? But they're all in, and they're not going to raise rates for the foreseeable future. If you look at the next slide here, rail loads, they're pretty crummy because exports aren't good. Energy is not doing well. Agriculture is not doing well. Manufacturing. So you see all these sectors of the economy slowly weakening. And 2018 wasn't a particularly good year here. So we really have to, here, intermodal. Intermodal 18 was the peak. 19's weaker because manufacturing was bad for most of 19. And 20 is now much weaker. And 18 here for intermodal traffic was the peak. Intermodal are the big corrugated metal boxes that they put on trains and take trains and then put them on ships and take them off ships and put them on buses, trucks, or trains or whatever to get them to some destination. But it's not just one mode of transportation. That's the key thing here, right? So this is weakness profound weakness here as well. And we're still in a bit of a trade war. That's having a little negative impact on exports, certainly. And the dollar is incredibly strong because in moments like this, when we're all nervous, what do? We want dollars. So the Fed's tried to alleviate that problem. If the Fed had the Fed not gotten involved in the middle of March and late March, when dollar demand was exceptionally strong in the middle of March, the dollar would have gone up even more. And they've tried to reduce it by supplying the globe with as many dollars as they want, because it's the reserve currency in most transactions, even not involving the U.S., just different third parties, countries, transactions are generally in dollars. Now, how bad's the recession? When did it start? It started. If you look at this graph, this is unbelievable graph. So the graph bounces around normally between positive 0.5 and negative 0.5. In the last recession, it went down to -4. Look on the far right. It looks like it's -9, right? It's worse. This is the graph. This is daily numbers on the graph. And you can see it's now in the negative minus low to mid 20s. This is unfathomably has been the decline in economic activity. It's unprecedented. The depression didn't come on this fast. It took longer to get there, and it lasted a very long time because there was no counter-cyclical G going on for a good long time, right? Here's another measure put up by the New York Fed. It shows things not as bad as I just showed you. This measure is as bad as it was during the Great Recession of 10, 12 years ago. So it's either as bad as that or much worse. I think it's worse, but we can argue, right? Oops, too hard to turn there. This graph shows us, again, I'm telling you the magnitude of this decline is unprecedented. You can see here 12 standard deviations. For those of you who had stat classes, that means like, well, we are experiencing now, I would have told you 2 months ago, it wouldn't happen. It's 99.999999999% unlikely to happen, but it happened. The saving grace again, G is strong, and the central bank is strong. We're having fiscal policy from Congress. We're having monetary policy from the Fed, and that will help. And wrong direction. You can see here on this slide, the recession historically vary in duration from 2 quarters up to as long as 6. This is pre-World War II, but after the Depression. This recession will last at most 6 months. It began in the middle of March. It'll be April, May, June. And by then, we're probably out and we're probably starting to grow again. So it's going to be very steep, and then we begin to recover. But the worst possibilities taken off the table because of the massive fiscal and monetary stimulus that we're receiving from the central bank, right? Let's talk quickly about labor markets. They're not tight anymore. They were super tight, like a snare drum. Now, throw the drum set away, punch a hole in your drum set. There's no pressure of any kind, none. Look at the far right. The bar, the vertical bar going up like that. That's weekly claims for unemployment. So all the lines below it, on the very bottom on the left there, to the left of that big line, that's 50 years of data. Prior to 3 weeks ago, the worst 1 week first-time claims for unemployment was about 700,000, and it was in the early 80s. 3 weeks ago, data for 3 weeks ago was 3.3 or 3.4 million people lost their jobs. Last week, it was 6.6, which was revised up to 6.8. And this today, data came out for last week at 6.6 million. We've had 17 million people lose their job in the last 3 weeks. And the government is trying to make sure by raising unemployment insurance amount and the duration that they can stay in their house, pay their rent, buy food, and not lose their place. They're trying to help corporations, small businesses by giving them the PPP money to help their employees, and they can borrow money and whatever. They're trying to do all kinds of things to keep the economy afloat so that when the coronavirus goes away and we can go out of our house, we have something to go to. But despite the speed at which Congress is acting, which is quick, and the central bank and the SBA, nonetheless, the number of people losing their jobs is unprecedented. And this will take its toll on the recovery. It takes longer. If you're still employed by your firm when things get better, well, you just walk into the office and start working. But if you've left your employer, then you got to find a new job. That takes time. Build new relationships. That takes time. go through a 6-month review when you're nervous and all that stuff. It isn't business as usual. So hopefully the first-time claims for unemployed numbers start to go down the rest of this month. And by the end of this month, they're now at a manageable level. And we're not losing millions every month. That will mean a recovery is going to take longer. Therefore, no V, but the U, or possibly the bathtub, or more likely, I think, the check mark. Here's another measure of what you're looking at here. And this adds unemployment in red. Next month, unemployment will skyrocket to 8, 9, 10, 11%. I don't know, whatever it'll be. Some spectacularly high number that we haven't seen since the Depression. The highest since the Depression was 10.8 in the early 80s. We hit 10% in the Great Recession of a couple of months ago, right? 10 years ago. In terms of wages, they're not going to be going pretty much anywhere. I mean, you may see weird oddities happening, like wages actually going up because you're going to let go of almost all your workers, your frontline workers, which are lower paid workers, keeping a few of your higher paid workers. So wages may appear to be going up, but in actuality, these workers aren't going to be making much money. They're going to be laid off. They're going to be furloughed, hopefully, or getting a small amount so they can get unemployment or whatever it is. But there'll be massive amounts of unemployed workers. Right? The saving grace here is that there's no inflation. There hasn't been inflation for 10 or 11 years. This is CPI. Headline in blue, it bounces around. Core in red, no food and energy. There's no trend here. It just blue bounces around with no trend. And red is pretty much flat like a pancake. So the central bank can say we can create money. We can give banks opportunities to make loans. We're not going to experience inflation. This is another measure of inflation. The next slide I'm showing you here is PCE, the Fed's favorite measure of inflation. It's a little different. The weights on the housing and healthcare are all different, and the way they change the basket is different. But again, no inflation. So don't worry about inflation coming, all this money coming on tap, and this lending taking place, and maybe as much as $2 trillion of money flat out, and $6 trillion of loans coming out. That's $8 trillion of money coursing through the economy. The economy's down, so much of it's just going to help C go back up and help people who are unemployed. But there's been no inflation. To imagine inflation coming is pretty tough. Now, what's going to happen to interest rates? They're going nowhere. The Fed just said today in a press conference, they're going nowhere. The rates are low and they're staying low, and they will buy bonds, treasuries, mortgage-backed securities, whatever it takes, in whatever market they can make a market in, with these new facilities that they're creating. And they're creating a whole alphabet soup of 8, 9, or 10 new facilities to keep the various pockets of the economy that aren't working, the financial plumbing, if you will, working. The first slide is just funny. Let's inject a little bit of levity into it. And you can see here, Paul Volcker on the far left was really tall. Inflation and interest rates were high. Then Greenspan, Bernanke, Yellen, and now Powell. And he raised rates because he's tall. But now he's lowered them to zero, and he's lowered them fast. This is important. If you look back 12 years ago to the Great Recession of 08, 09, and housing, it began in 06, 07, the central bank didn't get involved, and Congress didn't get involved really until TARP and ARRA. That was in late 8, early 9. This was well into the recession, right? The recession was 18 months. It began in 08. Government didn't get involved till 9 months into it. Here, by contrast, the recession begins middle of March, I would say, and within a week or 10 days, tons of programs are on, and now within a month, there's a massive amount of fiscal stimulus and monetary stimulus coming in, preventing us from having an absolute unmitigated disaster, right? So what happens to interest rates? They're now, that's the wrong slide. I apologize. They're zero right now. And they stay at zero at the end of this year. And maybe next year, they raise them by a quarter point. And maybe they raise them by another quarter point the year after. But rates aren't going to go anywhere. The Fed is telling investors, look, we're not going to screw with interest rates. We want you to invest in an environment where rates are going to be low for the foreseeable future. Whether that's a year, 2 years, or 3 years, or 4 years. It took them 7 or 8 years to raise it from the last recession. This one should be shorter. It's a different recession in every conceivable way. But they're not going to raise rates anytime soon. I could probably guess 2 or 3 years before they start to raise rates, before unemployment begins to get sufficiently low that they begin to get concerned. Now, as for housing, what do we see? Look, man, it isn't going to happen here for housing for a while. We looked at cars. Now, houses aren't cars. Houses are roughly 10 times as expensive as a house. You know, on the West Coast, maybe more like 15 times as expensive as a car. But you're not buying cars. Corporations aren't investing in plant and equipment. Houses aren't going to get built, at least in the short run. Massive increase in unemployment. I mean, sure, a few houses get built, obviously, you know. Bill Gates wants a few more homes to live in or something. But by and large, this ain't going to happen. You can see it here. Look at copper prices. Now, copper prices are a measure of overall construction activity and industrial manufacturing, right? Because anything that has electricity in it or a battery in it or something pretty much needs to have copper. Copper prices are down, way down, because there's no manufacturing going on. Now, China's driving a lot of this, but their stuff is also construction activities way down. So that's a strike against it. Auto sales, we know, are going to be really bad. How can it be that you're going to buy a house? People are going to say, ooh, let's buy houses, but let's not buy cars. No. Autos are more like houses than they are like going out to a restaurant for dinner or going on a boat cruise or, you know, buying a lamp or something, right? The other thing that we see here is first-time claims, first-time mortgage applications. They've gone down 3 weeks in a row and are now down through March, the week of April 4th, April 3rd, April 4th. They're down 33% year over year. They went down 11% 1 week, 2 weeks ago, then 24%, now 33%. They may well go down 50% before the bottom is reached, right? So looking at the same data here at the time series, right? Looking at it year over year in the next slide, this was the 24% decline 2 weeks ago in first-time mortgage apps. So now it's fallen a little bit more. So it's hard to imagine in this environment where cars aren't selling and existing home sales are down 33% year over year, that we're going to build a lot of new homes. I mean, new homes are a little different than existing. I understand that. I worked with the home builders for like 12 years. I get it. But there's a mood out there, and the mood isn't so bifurcated that we don't care about housing, cars, and existing sales. We're just going to focus on new sales, and they're great. There is good news, however. The good news is prices don't really decline much in recession. The last recession was different. That was the 08 recession, 09. And in housing, it started earlier. And you can see all the colored lines well below the horizontal axis of zero for a long time. But remember, that recession was centered in you guessed it, housing market. It's the housing bubble, the housing bust recession, we call it euphemistically, right? So if the recession starts in that sector of the economy, you can bet your bottom dollar that there'll be some really negative price action there. But the prior recession in 2000, 2001 doesn't even show up on this graph because rates were low. And the prior recession in 1990, which is pretty much the far left of the graph, there was a mild decline in prices of 5-6%. I would expect to see something in that range here. I would see very hard to imagine a bigger decline of 10%. And that would be, in my mind, really big. I mean, there are desperate sellers out there, but not a lot of them, right? In terms of supply chains for building new homes, there's some issues there. A lot of the supply chains do involve China, electrical parts, electrical circuits and circuit boxes and some appliances and stuff. But over time, over the next 4, 5, 6 months, I'm sure we'll reorient ourselves and buy more refrigerators from the States, and some American companies will begin to produce more electrical circuits and gadgetry and all that kind of stuff. But there's a potential supply chain issue that's working. We know that refi activity is spectacular, right? It's been unbelievably good. So good that the relationship between the 10-year treasury and the 30-year mortgage is broken down. There's so much business for refi now that they can raise prices and still have people waiting out the door to get it. Luckily, before this began, delinquencies in home ownership were really low. This is both Fannie and Freddie delinquencies on their portfolios. And you can see they're really minuscule. So that's good news. But the bad news is going to come. This doesn't have it here. And last but not least, before we go into this situation, FICO scores were solid. There was no credit deterioration. The problem is we've all lost our jobs. People who are working are not working so much. People who earn money in some business that they can work from home and are going to sell less and make less than they are. Lots of folks have lost their jobs, but there's all these mitigating factors. I can't stress it enough. For those who are unemployed, and now there's going to be staggering numbers of unemployed. Unemployment goes up every 1.5 million people who file for unemployment insurance, bumps it up by 1%. We could easily have 15, 16, 17% unemployment. But Congress has increased the duration of unemployment by 13 weeks from the normal 26 that most states have it. And they've bumped up the weekly benefit by $600 a week. So someone on unemployment will now get $2,400 more than what their state was going to give them. Which means in most cases, outside of the extremely expensive coastal communities, not all of them are on the East Coast, they can get by. That's important. It really is. I want to stress to you the fact that the recession is here. We've been now at it for 3 weeks. I bet March 15th is the first week of the real recession, right? The week of March 8th, 19th, that's the survey week that matters, is March 19th. That week is when the recession starts. It will be very sharp. The down will be very brief. And because of government intervention of an astounding amount of money, we will recover. We may not recover as fast as we want. And it may take us, if we're now in the early part of 2020, April 2020, it may well take us to the end of 21. That's 20 months from now. Fourth quarter of 21, maybe the first quarter of 22, so 2 years at most. I think to get back to where we were on February 29th, before the Vigoro hit the Mixmaster and everything went into the can. We will get out. The thing we're waiting for that's really unknown and we're all crossing our fingers on is how bad will Corona be? It looks like this phase here isn't so bad. Total number of deaths in the U.S., as terrible as they are, aren't going to be nearly as bad as what we thought a month or two ago. The issue is, when can we get out of our houses? We'll have been in our houses for 45 days, roughly, by the end of April. In Wuhan, it was 77. That's why it wouldn't surprise me if we go a little bit beyond the end of April to early May or middle of May. We need to have a plan of how to let people out of their house. Maybe we have landscape architects first, maybe marinas second, where there's just not a lot of people in close contact with each other. And we do this slowly, and we see how it reacts, and we do lots of testing and lots of tracing. So if someone's found to have the virus, we can not only isolate them, but isolate everyone they've been in contact with in the last couple of days. This is important. We have to have testing and tracing and a plan to get us out of our house. I want to see both of those. It's really important. And the speed of the recovery will depend on the magnitude of the decline and the duration of the decline. And that's still in the hands of coronavirus. We just simply don't know. I hope I've given you some food for thought. We have about 15 minutes for Q&A. I'm eager to take questions. And on the screen, you can see how to get a hold of me. My cell phone number, website, Twitter, all those things. And I put out 70 words on economics every day. No graphs, no ads, no charts, no links, no photos. If you want to get it, you can sign up at my website, econ70.com, or text the word Bowtie, no quotation marks, just one word, one string, 6 letters, no hyphen in the middle, no space, to the 5-digit number 22828. You'll be prompted for an email address. You'll then put it in. You'll sign up. You'll hear from me every day until you die. And as I joke, if you go to hell, I follow you there too, because I worked out a deal with the devil. In the meantime, if you live in the Northwest, in Seattle, Washington, or Oregon, enjoy your marijuana, get some good coffee, get some booze, and ride it out. And don't let the month of April darken your feelings about the economy. We will get out, but it's going to take some time. And in the very short run, I don't see housing doing much of anything. I hope this is great. I hope this has been helpful. Thank you. And if there are questions, I'm eager to take them.
Hey, Elliot, this is Mark Woodbridge of Builders Capital. So I've been fielding through the questions, and we have quite a few here. So some of them I'm going to condense down, a lot of questions around real estate. Most importantly, let's see here. I'm going to try to help navigate through this, all the questions that have been coming in. What would you say is the biggest takeaway for new construction market? A lot of our audience today are builders, and They want to know, what are you advising to weather the storm, and how would you answer that question on from a broad picture?
My inclination is, I think that you're not going to see much activity in the housing market till late in this year. You know, we're all in this wait and see mode through April, through May, through June. I know these are great months to build houses. I get it. Spring's a strong market in summer, but the uncertainty is just profound. We don't know what the risks are. We don't know what the uncertainties are. Big ticket items just seem to me to be a luxury item. You know, buying a house when you've already got an apartment or a smaller house. That just, if you want to build something and you really are full of beans and you really got some great land and some great location, you have to do it. Slow roll it out and have it come online towards the very end of the year is my thinking. You can't see single family, housing sales existing fall by 40% and not have it impact you. I mean, you got some great thing, a great price point or a great product. Okay. But think 3 times before you build and plan for nothing in the second or third quarter.
So a follow-up question to that is, if I'm in a location that seems unaffected by what is happening, there's pockets of the country where the real estate market's still strong, we're seeing pending sales, things are happening. Is it just a matter of time, or are there pockets that are going to go unaffected by this?
It's a great question, and we're watching that pretty closely. If you look back a week ago, if you divided the country up into counties that were won by Trump and counties that were won by Clinton, what you saw was that all the counties that were affected, were won by Clinton, were COVID positive counties, but the Trump counties were much lower. But they're catching up. They're catching up. So I'm afraid that those pockets are just coming later, and it's not that there won't be. That said, there is clearly a ranking here. If you look at a city like New Orleans, heavy tourism industry, Orlando, Las Vegas, right? These are very heavy tourist industries. They're going to get hit much harder than average. By contrast, you've got places like, objectively, Seattle, Portland, San Francisco. They're going to get hit much less. These are, in general, tourism, retail is all in all less important in these cities than those cities. So there's going to be variation among places. We're all going to get hit, but some of these cities will get systematically hit a little bit less hard, or in a few cases, much harder than otherwise. So think about how much of those key sectors have you got? Transportation, tourism, leisure and hospitality, trade.
Yeah, spring selling season is gone. What do you think about bringing a house out onto the market this summer or spring? Do you recommend waiting?
Summer. By summer, we're in the trough of the economy if all goes well, right? Some houses are clearly going to sell. There's no question. Every race has a winner. But I cannot believe that the activity is going to be very strong. It's just the shock has been too big. Wealth has been lost in the stock market. Younger people who are buying homes, their entry-level homes, they're affected by the service industry a lot, or the hospitality and leisure industry, or retail industry. And rich people are going to say, my equity in the stock market's fallen from, I'm making up a number, 2 million to 1.5, or from 1 to 2/3 of a million. And I was going to use that money to buy the house or down payment or the whole thing. And now I'm not going to have it. So unless we see the stock market completely recover and job growth just go crazy quickly, and I mean crazy meaning here over 1 million jobs a month on a regular basis. If we start seeing that in June and July, okay, all bets are off. The economy's good. That's unbelievable. I expect to hopefully see 500,000 to 600,000 jobs a month starting in late summer. That's what I'm hoping to see. We bottom out, and then we begin to improve, and the improvement is 600,000. If it's shorter problem and the job growth is better, watch those numbers really closely. Those first-time claims for unemployment, the monthly unemployment data, or I'll talk about it in my blog, but Those are the single most important numbers right now. But I'd be surprised. If we don't see autos going up, we're not going to see houses going up, right? Eventually your car gets expensive because repairs are high and you have to get to work and the car's broken. But with 10, 15, 16, 17% unemployment, it's hard to see housing taking off.
Do you feel there's going to be an opportunity in labor prices and material prices by waiting to do my project?
That's a good question, and it so depends. I mean, we know a couple months ago, 6, 7 months ago, they were closing down. A year ago, they were closing down forestry, lumber mills up in British Columbia and so on. Now the price of lumber's completely collapsed. The problem is, will there be a reaction on the price on the side of the producers here? If enough producers start pulling back on making drywall and making lumber and making all kinds of stuff, maybe we don't have a price decline. The price decline is matched by a reduction in supply, such that the equilibrium price is maintained, even though the quantity is much less. I simply don't know the reaction function of the suppliers of these stuff. If they don't cut production really fast, there'll be a huge glut. So yeah, I think production of all these things is going to go. The house is going to go down, and the inputs are going to go down. The demand for the inputs is going to go down. But how fast will supply fall? I don't know. Watch that number. Call your contacts. Talk to your lumber yards.
Do you have any thoughts on what do you expect banks to be doing on lending on new construction projects?
It's a great question. I think banks are being encouraged to seriously lend, right? They're really being encouraged, but they don't know what the collateral's worth. They don't know the price of much of anything. There's no equilibrium situation that's been reached. Price discovery is still going on in these. I mean, we're struggling with price discovery in stock markets, which are the most liquid markets in the U.S. stock market, which is the most liquid market in the whole world. And so it's hard to gauge what the fair price is for a piece of land, how much to lend against it, what the house is worth. Until these questions get sorted out, I'm inclined to think they'll be a little reluctant. It'll be a lot like these loan officers who have all of these loans written, just waiting on the shelf to go when they get permission from their warehouse lender to start lending money. The lenders are nervous. They don't want to do it yet. There's so much uncertainty and risk out there.
With this lag, should we continue to develop land to be ready to sell in the fourth quarter?
That seems like a better decision. I'm not sure it's the right decision. I mean, I'm much more certain in that building a $500,000 house and it's ready for June that's not the right decision. But working on infrastructure that takes a long time, or having some of the infrastructure done, or having a piece of it done, or mapping it out at least and getting the permits all done so you're ready to go when it starts at least, or maybe somewhere in that range of you doing something, come June, July, you're ready to go. You're starting work on it come June, July, August, so that you've got some lots available not too far thereafter. Something along that is probably a better decision. And that may well make some sense. I'm more optimistic on that one. Because at some point we're going to get happy. And builders are going to say, oh, I want to build a house. They're not going to have any lots. They're going to come to a developer. Well, I've got some lots for you. Think, but don't go too far on this either. Don't compromise your balance sheet at this point. This is not the time to take a huge risk and bet the farm.
Do you believe there's going to be an uptick in distressed assets going into the end of this year?
There'll be less distressed assets than we think. There'll be some, inevitably. But there's so much money sloshing around from the Congress, and there's so much lending being done by the central bank that they're trying desperately to keep everybody where they live right now. They're trying to keep small businesses alive, big businesses alive, unemployed people alive. They're trying to keep businesses to keep their employees by bribing them with money. I mean, these are all the right things to do. I don't use the bribe here in a negative connotation. That it's hard to see wholesale foreclosures and defaults on residential, a multi-fam structure, single-fam structure, and so on. I mean, there'll be some, but it's hard to see cascading effects going on. This $6 or $7 trillion of money should short circuit those programs. We already know that what, a third of renters haven't paid their bill or something along those lines, right? And a large number of small businesses haven't paid, but they're going to get forbearance in many cases from Fannie and Freddie. The services are going to have to pay. If it's a multi-fam structure, Fannie and Freddie will give them forbearance if they don't kick the tenants out. So they're doing everything we can to reduce this rash, this huge uptick in distressed assets. Some, but much less.
Okay. This question's come through a couple times, actually. Given the pattern that we have a recession typically every 8 to 10 years, even though this may not qualify for a recession, should we consider this our 10-year recession, or should we be set for another one here soon?
I wish I knew. I would not. The fact that they have been about 10 years apart is absolutely true. 1990, 2001, 2008, and now 2020. Right. But this one's unlike any of the others. It's this one gets a pass, I think, on that score. Now, that said, it's cleaning out a lot of mess that's out there. You know, there's too much corporate debt out there, non-financial corporate debt, and some excesses that we're developing are going to naturally be eliminated here. So I think that this means that the next recession is not going to come soon. Unemployment's gotten way up, so there's now lots of labor available to run the economy strong for next years and years. We could have 500,000 new jobs for years and years, and for 2 or 3 years before we ran out of workers, 2 years or whatever the math was, 3 years before we run out of workers. So this suggests that the next recession shouldn't come in the near future. Next 3 or 4 years is remarkably unlikely. It could well be 10. But who knows if there's not some other supply shock out there. Remember, the recessions of 73 and the recession of 79, this is a long time ago, mind you. Those were also supply shocks by OPEC, where they reduced the supply of oil, pushing inflation up and causing lots of mass expedited depreciation on assets and stuff, wrecking our economy twice. So don't bank on it, but I would bet that the next recession is probably at least 5 years away, given what's happened in this situation.
What do you think of the real estate market going into Q1 of 2021?
Oh, that's already 10 months away, right? I think by then we should be experiencing very good growth. So assuming that the foreclosures and defaults that we've already talked about are relatively low, so distressed property is not all that big, and the job growth is now starting to come in at 500,000-600,000 a month, people are going to say, hey, things are good, my job is back, the stock market's doing fine, let's take a gander and do something nifty. So, 9 months from now, 12 months from now, yeah, I think selling season a year from now should be pretty good. I mean, it really should be. With the Fed offering to do everything they have to keep liquidity going, and the amount of unemployment insurance and PPP programs and big programs for airlines and stuff. Yeah, if we're not doing well 9 to 12 months from now, that's a real problem. Then we're in a very serious problem. Corona's come back with a vengeance. We still don't have a treatment plan, a protocol, and we don't have a vaccine. I mean, this would be unimaginably bad.
So what's the one piece of advice you'd give folks in real estate today to weather the storm and get through this economic pandemic?
It's probably more than one. Don't risk your capital structure. Keep your capital structure solid. And be aware, I mean, to get the V-shaped recovery people talked about before, that's unrealistic. It takes a long time to constitute or reconstitute an industry and a business. It's complicated to find good workers, to find good vendors, and all the things that are involved in building a house is complex. Finding new supply chain suppliers if they've gone bankrupt. The V was dependent on everything going right. And everything never goes right. So that's why the decline can be steep, but the recovery can be much, much weaker. Strong, good, but more looking like the check mark, where it goes down quickly and then takes a good long time to go up. But we can withstand that. So I would temper your expectations on the recovery here. It will happen and it'll be good, but the second quarter will be horrendous. And it'll take a while to find the bottom here. I mean, June, May, June, July. We're bottom feeding here. No new bad news, hopefully. We're getting out of our house. But buying a house ain't going to be the first thing. At least in my case, the first thing that's going to happen is I'm going to a nice bar and buying a gin and tonic.
I'm sure real estate or alcohol sales will go through the roof right after this. So should we buy stock and Corona?
Yeah, I think that's a great place. Constellation and a couple other ones. Yeah, Pernod, Ricard, and whatever they are.
Bacardi. What is this? What do you think of the multifamily market as far as apartment buildings and the commercial lending market?
I don't know enough about that, but again, I do know that the number of defaults should be pretty minimal because Fannie and Freddie are letting people, telling the owner, the landlords, not if you don't kick them out, we'll give you forbearance on the mortgage, and the increased unemployment rates and so on. But we also know we have a secular shortage of housing. And housing is very expensive, and housing keeps getting more expensive. And it's not like we're building more homes now, but we're having more babies, not because of the recession. We're not going to have a baby blip in 9 months. But the chronic shortage persists. So in 2 or 3 years, when things are really awesome, we're back in the soup again with no supply of housing, right? So as housing gets unaffordable over the secular period, I think the role for multifamily remains, the prognosis for multifamily is very good. The thing to keep in mind a little bit is, where will we live? Will there be a little change in how we live and where we live? If you live in Seattle, maybe now you move to Pierce County, or you move to Thurston County, or you move to Bellingham County, far north of Seattle, or relatively far south. If we can commute to work, will that change our commuting patterns? Will that make the buildings that were very valuable a little bit less valuable? I would spend some time thinking carefully about that. Office space becomes less valuable. Some multifam becomes less valuable, I think, but I'm not sure. I'm not sure where.
Well, that plays into another question around the top end of the market, the luxury home market. How do you see this affecting that?
In the short run, it's got to hurt it. It's got to hurt it. There's no question. You can't look at your stock market wealth or your, paintings and all these other assets that rich people have and say, oh, gee, it's all down. I'll buy a house. That's unlikely. Think back to the recession of 08, 09. Was there much activity going on there? A different recession, albeit I understand that. But recessions aren't great periods for big purchases. We will have to see the stock market improve. Now, the stock market could improve very rapidly. Were an injection, some vaccine to become available that works, the stock market would jump thousands of points because that means it's the end. You can do what you want. You can lick the floor in the bathroom, the public bathroom, and you're not going to get coronavirus. I mean, that's a big deal. If we even get a treatment that works, if we even know we're not going to get a double dip in corona, that would do good things to the market. And that would cause the upper income people with large savings, who have the savings, who drive the upper end of the market, to be much more willing to part with their money and be a little more profligate. But I'd like to see the stock market go up and stay there. Right now, we've had this huge decline. We've made up about half the decline. And do we now level off here roughly? Or do we keep going up again? I just don't know. But that's what I'd be watching. But I bet they're going to hold off at least for some months, 3 or 4 months.
Okay, well, we could probably stay on here all day as questions come in, but I think we're going to wrap this up. Elliot, anything to add about the market and anything you want, parting information you'd like to give us?
Yeah, I think that the speed and magnitude of the congressional action with the administration and the central bank are really remarkable. And when you really have a bad day and you're convinced that the wheels are falling off the train and we're going off the rails, it's going to be a shambolic dumpster fire. Remember that the central bank and Congress have got our backs here. They really do, in an unprecedented way. And this will make the recovery better, the length of the recession less, and its severity less, assuming COVID gives us a little bit of cooperation. Watch the COVID process, listen to what Fauci says, right? Elbow bump, and watch those first-time claims for unemployment numbers. They come out every week. Thursday, 8:30 East Coast time.
Rob Trent, are you online?
Yeah, I'm on. We'll go and close this. So this is Rob Trent, CEO for Builders Capital. We hope you all took away something useful from today's webinar. We had a great turnout. Approximately 450 people joined us, and we appreciate you all taking the time to listen. We'd like to again thank Dr. Elliot Eisenberg for taking the time to prepare and offer his feedback and ideas on the economic environment going forward. I know how instrumental he's been in our business, providing us with future economic outlooks. So once again, thank you, Elliot. And to all of our valued customers, we sincerely appreciate your patience through these very challenging times. Please know that we're here for you in any capacity we can be, and we will always support the success of your business. Most of all, we hope you and your families remain healthy and safe through this economic temporary pandemic. And until next time, have a great week, everyone.